Gold prices break $4,000 per ounce. Sounds crazy, right? Well, according to Goldman Sachs, that scenario might be closer than most people think. Goldman already predicts that gold will hit $4,000 by mid-2026, but here's the twist. They believe that there are two more powerful forces that could push gold even higher beyond that already ambitious target. So in this video today, we're going to break down exactly what those two reasons are, why they matter, and how could they create a domino effect that drives gold prices to record-breaking levels. So without further ado, let's get right into today's video. Gold has always been more than just a shiny metal. For centuries, it's been a safe haven, a way for investors, governments, and everyday people to protect their wealth when the world feels uncertain. Fast forward to today, and that role hasn't changed. What has changed is the scale. Central banks are buying more gold than at any point in recent history. Global financial markets are shaky, and inflation remains a worry in many countries. Against this backdrop, Goldman Sachs made its forecast. Gold could reach $4,000 an ounce by 2026, but they also added something that grabbed investors' attention. Gold could go beyond that. And the reasons are not any wild guesses. They're based on real trends unfolding right now. Gold's price has already surged about 14% since late August. That's a big jump in just a very short time. But here's the surprising part. Very little of that rally has come from speculative money. But what does that mean? Speculative money refers to hedge funds, traders, and investors who buy and sell gold in futures markets or options markets, often with leverage. They're not holding gold to store value, they're betting on price movements to make profits. Goldman found that speculative flows explained only about 1% of that 14% surge. In other words, most of the rally was driven by long-term buyers like central banks and institutional investors, not short-term speculators. And that's exactly why Goldman sees room for upside. Think of it like a sports car. The car is already moving uphill quickly, powered mostly by a strong push from behind. But the engine, that is speculation here, hasn't even been switched to full gear yet. When traders and hedge funds finally pile in, they could supercharge the rally, sending gold racing past the $4,000 mark. The second reason Goldman highlights is demand from gold-backed ETFs. These are popular investment vehicles that allow regular investors to gain exposure to gold without physically holding bars or coins. Now here's the important detail. Goldman's model had predicted that ETF demand in September would rise by about 17 tons. That's not just a small number, but it's manageable. Instead, demand skyrocketed to 109 tons, more than 6 times higher than expected. This shows that private investors are moving money into gold much faster than Goldman anticipated. People are pulling cash from other assets, like bonds, and choosing to store it in gold. Why does this matter so much? The answer is because the gold ETF market is still relatively small compared to huge markets like government bonds. So even if a tiny fraction of money shifts from bonds to the gold, the impact on gold's price is magnified. It's like pouring a bucket of water into a glass instead of a swimming pool. The glass overflows quickly, right? Now let's put all the pieces together. On one side, you have ETF demand and private investors already surprising to the upside. On the other side, you have speculative traders who haven't even fully joined the party yet. When you combine those two, you get the possibility of a powerful feedback loop. Rising ETF demand pushes gold prices higher. Higher prices attract speculators who see profit opportunities. Speculators buy in, pushing prices even higher. The cycle repeats, creating momentum that could carry gold well past Goldman's $4,000 baseline. course, no forecast is bulletproof. There are real risks that could stop gold from smashing past $4,000. Interest rates. If central banks keep rates higher for longer, bonds will become more attractive and investors may prefer them over gold. A stronger US dollar. Gold is priced in dollars, so when the dollar strengthens, gold often weakens. Risk appetite. If stock markets start booming again, investors may shift money back into equities. Speculative reversals. Just as speculators can drive prices up quickly, they can also exit just as fast, dragging prices back down. These risks don't cancel Goldman's case, but they're very important reminders that gold is not just one-way bet. So the question is, do you think gold is heading past $4,000? Or do you believe the risks will keep it grounded? Drop your thoughts in the comments down below because this debate is just getting started.